So first, yeah, it may be great news that Cips reopened January exam, and now you can take like six exam series in a year. And however, it's this January exam is only about OR, just like with September. So here we may have a stronger emphasis on L4M2 and other OR modules rather than the CR. So with this one, I would like to help you with the key topic since the whole module is pretty long and also it's pretty difficult to compress them into a single topic. Now, compress them into a single session of about 1 or 1.5 hours. Now, I will help you to look at some key topics of FM2, which may represent a large share of questions. Something may look like this, like first about the cost and price analysis, about the different type of cost, direct, indirect, variable, and fixed costs, and the potential may accompany them. Second, about the budget and cash flow. And then we may move into the industry analysis and market analysis too, like the Porter's five forces and the product life cycle. Finally, we look at the specification, majorly about the conformance and performance specification and how to improve them using certain methods like special, standardization, value analysis, and value engineering. Now, let's look first into the topic of cost and price analysis. So first, this is the topic from part 1.2 in the study guide. And we have several ways to analyze the cost and price. Just to say, before we decide to purchase something, we need to know the price, and it is essential of any negotiation in procurement. Therefore, we need to analyze them, understand the cost, the potential costs that the supplier may incur, and the selling price that they may put, that they may charge us. And if you understand both of these, then we may have a better strategy for negotiation and also a better model to select the supplier. We cannot, may we may avoid the overcharging or overpriced suppliers and focusing on the most value for money product and service instead. To do that, then we need to analyze both cost and price. So we have the cost analysis and the price analysis. The price analysis simply means comparison across the product or services, and we may use some method or some benchmark as the price comparators, like the current market price using several quotations from different suppliers, or you may use a historical price or the quotation from some benchmark index like the commodity price and so on. So that is price analysis. Simply comparison across the products and service for different type or different offers from the market. On the other hand, we have cost analysis. Instead of look at the price only, we need to look at the constituting costs of a product. So here we need to analyze the product, break it down into the different elements, into cost elements, and try to find the just price for each of the element. The cost analysis is impossible to do without price analysis. And although price analysis is pretty easy to do, you just need to collect a few quotations from the market. The cost analysis means you need to look at each element and compare the price altogether. So normally the cost analysis is only applicable when the product is of high value or the contract is of high value and you have little to no comparator. So for cost analysis, you need to understand the cost structure of an organization. Normally, we can divide the cost into a few ways. So we have majorly two ways. First is split the cost between direct and indirect. In other words, we are looking at the cost of a product based on the relationship between the elements and the final product. So for direct and indirect, then the direct expenses are the expenses that link directly or contribute directly to the end product, like the raw material and the direct labor as compared to the final product. And for indirect costs, they are indirectly contribute to the final product. So mostly they are the overhead and other administrative costs that contribute to the organization. So they don't directly associate with the final product. They don't directly constitute the final product, but they are there just to ensure that the organization is normally function. On the other hand, we have the fixed costs and variable costs. Fixed costs are static. They are the costs that don't change when the output change. So they are relatively static, like the rental of warehouse. They just the fixed cost. Every month we incur the same charge, no extra charge, just the same thing. For variable, they change according to the output. And the more output an organization has, then the more variable cost they have. Each of these categorizations may have different implications. So for direct indirect costs, we majorly use that to decide and to categorize our costs and how to approach to the supplier. Like you see that direct costs may have more implication to your organization. Therefore, you need to talk more and have a better relationship with the supplier. For indirect costs, then we may approach in different way. For fixed and variable costs, they can be a key input for break-even analysis. And for the marginal costing and also for attribution costing method, where you need to understand the cost of the supplier. Anyway, then for L4M2, they don't require you to understand these in deep because we are not studying cost accounting. We are studying for analyzing the cost and price and create an estimate in the business case. So you just need to understand how these cost categories different, how these cost categories differ, and how to and how we can manage them, and also get information from supplier. Anyway, then majorly the question from the exam tend to focus on potential costs and ask you to identify certain direct, indirect costs or fixed and variable costs. For example, they may have a certain industry like furniture or book publisher, right? And then they may give you a few keywords or a few costs and ask you to identify whether they are or to identify which of the following are fixed costs or variable costs or direct or indirect. For example, the book publisher may have some direct costs, but also they may be fixed, like the royalty from the author. So, in copyright law, then when someone, the author may have the right over their work. So when another entity like the publisher want to use that work to print them and copy them, then they need to pay the author, and money, that income is known as royalty. So that income, or sorry, that royalty contributed directly to the end product, which is the book. So it is a direct cost. But this direct cost, depending on the contract, they can be fixed or variable. Certain certain arrangement with the author, like the author may authorize the publisher to print the book with a fixed price. Okay, they receive the royalty based on fixed price, or they may agree to um, charge the royalty based on the number of copies. So depending on the case. On the other hand, we have other industry like yeah, we have furniture, which is the wood, and also the automobile or car manufacturer. They may have certain input like the chassis, the engine, the tire. All of them are direct, but other are indirect, like the rental, overhead, administrative, and consulting. Yeah, they are indirect. So the question here are pretty simple. You just need to identify the direct, indirect, fixed, and variable costs in certain scenarios. Of course, they are objective response. So you just need to select a few key items from the list. Okay, essentially, when it comes to cost analysis, then we need to understand the method and get the where we can get the data. Okay, so it also associated with the uh, primary and secondary sources of data. When it comes to the data about cost then and price, we need to collect majorly from our suppliers. So we need to consider them as the primary source of data, and anything else like comparison websites or government report or journal report or any any published magazine, they are all secondary data. And except that, we collect the data like quotation or the characteristic or the product specification from the supplier. Then the everything else is secondary source of data. In slide guide, you can also see that we have a table of different analytic methods. So we have a few ways. I can name them like I can summarize them as the price analysis, as cost analysis, and the whole like costing. So for each group, then we may apply them separately. For example, for routine item, according to Crunchic matrix, we can majorly use the price analysis. For leverage item, we can use the uh, cost analysis, and for capital item, then we can use the whole like costing, etc. And for strategic item, then we can use open loop costing or the competitive assessment. So depending on the case, then we may apply different methods. Now, just have a quick look over the budget and cash flow. This is part 1.4 in the study guide, and it may constitute quite a lot of questions. Okay, and throughout level 4 exams, and especially in L4M2 and L4M4. You can see that Cips has a pretty strong emphasis on finance, cash flow as something procurement must know and be able to analyze in their job. So first, with the cash flow and budget, first we need to understand what does it mean by cash flow. Cash flow means how much cash go in and goes out of your business. And when we have more inflow than outflow, then you have the net positive cash flow. And when you have more outflow than inflow, then you have negative. So it's like blood for a business. When we have blood, then we live. When we don't have the blood, then we die. Therefore, cash is sometimes considered as king in real transaction. Therefore, as procurement, you need to understand the cash flow and the impact of transaction with supplier on the cash flow. Therefore, you need to understand about the inflow and outflow and how to maximize or optimize your cash flow. So we have basically two flows. First, we have the inflow. Inflow means the cash coming to your account. So we can have the cash from sale, the cash from investment, the cash from the bank loan. On the other hand, we have the outflow. Outflow means the expenses. You need to pay money, pay cash to different stakeholders, like the supplier, like the employees, like the government through tax, like the bank through interest, and to the shareholder through dividends, and so on. Here, the problem is we want to have more flow than outflow. And in procurement, we majorly deal with a single type of stakeholder, that is the supplier. Therefore, we may want to maximize our cash flow through managing the supplier payment and their payment term. With this in mind, then to maximize the cash flow, we need to maybe delay the payment or negotiate with supplier about potential delayed payment and use the money or either cash from revenue as a way to finance the business. In the exam, you may see that there are a few questions about certain action or certain activity may have positive or negative impact on the cash flow. So you can imagine that anything that causes the outflow is negative, and anything that causes the inflow is positive. But also there are certain financial standard or certain financial practice, accounting practice that doesn't incur any flow. For example, we have depreciation and amortization. Depreciation can be recorded as an expense within an income statement. However, it doesn't impact the cash flow at all because in depreciation, in principle, it is just the devaluation of an asset over time. So it is just an estimate of how much this asset lose value over that year. It doesn't incur any cash, unlike paying the supplier or paying the bank. Okay, so depreciation doesn't have any impact on the cash flow at all. But you may argue that it may have the indirect impact. It is correct as well, since depreciation is an expense and it is deductible expense when we calculate the tax. So it may help you to reduce the tax payable to the government. However, that phenomenon, that accounting practice, depreciation has no impact at all on cash. And on the other hand, we may consider about some things that have positive or negative impact on the cash flow. For example, when we purchase more inventory, then absolutely it has negative impact on cash flow. You need to pay the supplier, and you need to pay for the holding costs. You need to rent the space for the warehouse and so on. So inventory anyway may incur the cost, and it may risk to become obsolescent or redundant, also impacting on the cash flow. All right, so absolutely negative. Or when a supplier wants to speed up or shorten their payment time, then of course that is a negative factor because we need to speed up the outflow. Okay, so our cash outflow is, yeah, we need to spend more on that supplier. Okay, so for the cash flow here, you need to understand how to make or how to balance the interest of your business and focusing on the right thing. Therefore, we need to manage our inventory, speed up the collection from customer, and try to delay payment to the supplier. There are several ways to do this, and it does not involve not just involving the negotiation, renegotiation with the supplier or the customer. We can do that in more friendly way. So this could be a question in level 5, L4M4. Okay, so I may skip this and move on. Now, let's look at budget. All right, so budget and cash flow are posited in the same section in the study guide, that part 1.4. With budget, it's essentially a type of plan, a type plan. So when you plan to do something like plan to organize your day may go through several activity and each activity may incur time. So you plan for each activity. This time for work, this time for meals, this time for sleep, and this time for family, and this time for entertainment. Okay, so you divide your time in that way. The same applies to budget. It is a kind of planning, but it involves money. So we decide that certain part of our money is spent on certain expenses, like for food, for, yeah, that is personal, but for business, then certain time for certain budget for materials, certain budget for employees, certain budget for investment, and certain budget for financing, or certain budget for emergency funding, right? So there are several ways to create that kind of plan. But here I'm introducing 3 ways. First, incremental budget. This is a very basic and probably the simplest way to create a budget. Uh, it doesn't require much activity. We just need to copy the budget or the expense summary from last year and then put it to it this year and round up or adjust a few number. It can be done pretty quickly, but also offer a very rigid way to come to the budget, and it doesn't allow the stakeholder to consider about their activity. So it is only appropriate when we design the budget or we devise the budget for a largely static activity like the budget for salary. Salary here tend to grow pretty slow, and they only adjust to inflation. So it only works with certain type of expense like that. We also have other type budget. So let me introduce the rolling budget. Rolling budget means we always plan a time ahead instead of focusing on just a fixed period. As you know, for business, then they tend to budget for the whole year. However, for rolling, first of all, yeah, sorry, I need to say about traditional budgeting. For traditional budgeting, they tend to focus on a accounting year like 2025 or 2026, and they may create a new budget at the end of 2025 to prepare for 2026. Okay, so that is a pretty static budget. But for rolling, instead of just planning like that, then they always try to plan a certain time ahead, like 12 months ahead or 18 months ahead. Instead of just making the budget for 2026, then when when reaching the end of the first quarter 2026, they decide to pre-planning for the first quarter of 2027. Okay, so with this one, we always rolling forward and we always planning forward in 12 months, not just not just for the upcoming year and not just doing this at the end of certain period. We do this all of the time. So it has its own advantage. The disadvantage is that maybe it requires a lot of effort and consume quite a lot of resources when it comes to budgeting. The third type of budgeting is using the zero-based budget. With zero base, it is the opposite of incremental budget. Instead of assuming certain activity, then every stakeholder, every department need to build their own budget from the scratch. And the planner or each department must imagine about the potential activities they may do in the next accounting period and allocate their spend accordingly. And then accounting department need to summarize this and allocate the potential budget. Maybe they may have some argument about the potential expenses on certain activity, but it is subject to renegotiation between accounting, between the senior management and other departments. One important part of budget is that when we create a plan or budget, then it rarely goes with the reality. So it totally normal. It is totally normal. The thing is, we have a budget because we want to control our spend, and we have plan because we want to control our activity. So when there are some difference between the plan, between the budgeted and the actual events, then we need to understand why and how we can adjust further on. So with budget and with accounting, then it is important to know about the variance analysis. The variance is the difference between the budget and the actual expense. So we need to understand how this variant, how and why this variant may arise. And in the next period or within that period, how can we adjust ourselves? So with variance analysis, simply you need to know the difference between the budget and the actual expense. But it is just half of the equation. You also need to know about why such variant happens. So first, we may have several types of variance. First of all, the direct spend variance. So for certain materials and certain category, then we decide that they have a budget, but but it has some variance. The actual thing may rise or fall depending on the market. So we need to understand how this may differ and what are the reasons for this difference. Therefore, with direct spend, we need to identify whether it is from the unit price or the quantity that caused the variance, and we can adjust it in the upcoming period rather than leave it static and ignore the plan altogether. Here, with each type of variance, we need to know the causes or the reason for variance to arise. For direct spend, that is the difference in the unit price in the market or the quantity may cause difference. For the labor, it is the wage rate or the rate per hour and the efficiency that cause the difference. And for the overhead, it is the volume or the expenditure that cause a problem. So when we see that there variance and we understand where the variance comes from, then we can adjust our plan. If the budget for direct spend is about to be surpassed, then we can adjust by um, increase the budget because the unit price is also increasing, or we can cut down on the quantity and keep everything under control. The same apply to labor variance and overhead variance. When you see that the expenses for labor is increasing, it could be about the minimum wage is increasing or the efficiency is decreasing. So everyone must work extra time to compensate for the loss of efficiency. So depending on the reason, you can suggest the adjustment like using or invest in new technology to improve the efficiency. Now, let's look at the second chapter, and look at the potential question here. With second part, they tend to ask pretty much about about different market analysis tools like the Porter's five forces or product life cycle, especially the Porter's five forces. What are the determinants of buyer or supplier market power or bargaining power? On the other hand, sometimes you may see certain questions about different industry, like manufacturing, construction, agriculture, finance, and other industry as required. So here you can see that I attempt to analyze certain industry with their key features. You can see the same from study guide, but I don't think it is very well constructed. So here I just summarize them in a more memorable way and uh, more approachable. Okay, so with manufacturing, then normally they have pretty high barrier to entry with a lot of investment requirement. However, this industry also this industry also have pretty strong, pretty decent profit margin. For manufacturing, as you can see, then it requires a lot of investment in different area, like into the technology, machinery, and the facility. Also, it requires a strong relationship with the supplier and with innovation. To keep the cost down, they may leverage the economy scale. And in manufacturing, then achieving economy scale can be pretty difficult, especially when we consider about the market. In certain time manufacturing, like with FMCG, they may face high requirement for brand and higher investment in advertisement activity. But for other type of manufacturing, like for heavy industry, the manufacture of heavy machinery, then they focus more on engineering and technology rather than brand. But for FMCG, including car, then investment in brand is necessary. Second, let's look at finance. With finance, then it involves the market and liquidities of certain financial assets like bonds, like shares, and also the commodities and other financial assets. So for this industry, then the profit margin can be pretty high, but it has majorly some requirement on the capital and on economy scale. So financial among these three industries have pretty high profit margin, and it is highly it may attract a lot of talent or a lot of interest from the media. Finally, we have construction. Construction is pretty interesting. They also have high requirement on investment, like about the right equipment, the right skill. They need a lot of labor and a lot of initial investment. But their productivity doesn't rise for a long time because each project is treated differently, not in scale like in manufacturing. So construction has a disease that is low productivity growth. And furthermore, for the contractor in this industry, then the profit margin tend to be lower than both manufacturing and finance. Uh, there another problem with construction. The construction is project based, so the labor tend to be fluctuate, and they don't have actually also the company doesn't have any long term commitment with the labor, unlike manufacturing. So in construction, they tend to use more casual labor rather than permanent labor. You may see that in the exam, there are a few questions look like this. They may give you a few key hints into certain industry and require you to identify which one is this. So it may help you. It may help when you can identify the industry based on their characteristic. First of all, with manufacturing, then it has the requirement on economy scale and on the investment in machinery and also strong application of technologies and robotics and automation. For finance, it is characterized by by high profit margin and strong or very strict regulatory environment. For construction, it is typified by the use of casual labor, by lower profit margin, and by low productivity growth. With the Porter five process, then we can have pretty many questions. Okay, so as you know, Porter five process is a model about the it's a model about the structure of an industry. And an industry may be shaped by several forces, unlike what they thought before, that the industry is majorly shaped by competition. So Michael Porter suggests that there are other forces that may shape the industry and overall affect the profitability of the competitor within this industry. So the five forces include first the rivalry or the competition, second the threat of new entrant, the threat of substitute, the bargaining power of buyer, and bargaining power of supplier. When we apply this model into procurement, then we want to understand the market structure in the supply market. We want to understand the structure of our supply market and potential way to negotiate with the supplier. So with this model, we sit here as the buyer. We sit as buyer here, and we have our own bargaining power. And we look at the market and look at the competition pressure on the supplier, whether they have strong pressure or whether they don't have any pressure at all. So we can decide our strategy to buy from that market. For example, if the rivalry between the competition here is pretty weak, it means that there are very few competitors here or a single supplier dominate the market. We may want to expand the market by looking for international partner. Okay, not just looking from our own country, but we may expand and looking at a larger supplier base. Or we can try to invite the new entrant into this industry by using uh, by using performance spec and open up the possibility of you to use the substitute product. Therefore, for this kind of model, you may want to understand different determinants of each force and how we can shape the market in our own way. The exam may test you the same thing. They want to check whether you understand different determinants of each force here. So you can see this. You can see that on my screen here. I'm listing a lot of determinants for each force. First of all, for the rivalry, then they can be decided by the number of competitor, diversity, concentration, growth, the differences, brand loyalty, and so on. For the threat of new entrant, then they have several barriers to entry, like the economy scale, the brand loyalty, the capital requirement, and so on. Therefore, in the exam, in the exam, in the exam, it is pretty typical for you to see the question like about in which situation the power buyer may be stronger or the power supplier may be stronger. And there could be a question about what could be barrier to entry and what may decide the substitute product. But they may also ask you about how we can shape the market in our own way. For example, when we want to expand the market and invite the new entrant and invite the possibility of other substitution, then what we can do? The answer here is to use the performance spec and allow the supplier to innovate or suggest innovative ideas. Okay, so we can expand the selection and uh, not relying on any supplier from the market anymore. Okay, so that is about the Potter's five forces. Uh, we just we not just learn from this model, but also connect that with other part in the study guide. Now, as you can see, the Potter five forces are have the Potter five forces has very strong connection with the specification, and different specification may decide the outcome. Like using the performance spec may allow the supplier to innovate, and using performance spec may require a lot of technical knowledge and also pretty precise and may help you to fit the item into an existing environment. So for the five forces and the type specification, they have very close connection, and you need to understand the implication of using the spec on the shape of the market. Anyway, then with the specification, we can have a lesson here. Um, as you know, we have two types of spec, the conformance and the performance, and each type may have different implication on the market and on buyer and the supplier. For conformance, it focuses on the input, like the design, material, the manufacturing method, and other description. We may also use a standard and other model for conformance spec. However, conformance spec is pretty hard to produce and it requires technical knowledge. And potentially, maybe in the organization, we may need to have the advice from the technical department. Conformance spec may have when you know exactly what you have. However, in other cases, conformance spec is not a good thing. When the product fails, but the supplier provide that according to the spec, then the liability lies with the buyer. So we cannot claim for damages from supplier anymore. Therefore, it must be very careful to produce a conformance spec. And if we are confident that we can produce a conformance spec, then we only do that in that case. On the other hand, when we don't have that confidence, then confidence spec is not a good choice. But we can try to create a confidence spec based on certain input, like using existing standards or using the catalog from our database and so on. On the other hand, we have the performance spec. Performance spec tend to focus on outcome, output, the function, or the result. So it could be easier to prepare, and we can understand that what the end user may need, what procurement may need, and prepare that description of the outcome and the output. And um, one of the advantages of performance is that the supplier is totally responsible for the product failure. If the product fails to achieve the outcome, then supplier must do that again. However, if we don't use performance spec correctly, then it may lead to ambiguity and supplier doesn't know what you want. Performance spec is perfect when we consider about the innovation, when we consider about the new technologies, when we consider about the potential of opening up the market and inviting new supplier or new solution. So it can be used in those cases. Otherwise, conformance can be used when we already have the standard, when it needs to fit into an existing environment. And when we want to ensure that everything is according to our own design. So both type of specification have their own use, and we need to be flexible. In the exam, you may see that pretty many questions are about specification, and most of them are like yes and no. So you need to read the question and decide whether we should use conformance or performance spec. On the other hand, then we can have a few other questions about different structure or the content of each spec, like about the input output function or the design or the material or the dimension or the list input. Okay, so you need to decide which element belong to which specification. I think that question is pretty easy to do, and you can ace the exam based on my suggestion here. Finally, we have the spec, and then we need to improve the specification. Specification improvement is a necessary step when we work in procurement, and also we need to work with the supplier. So over time, our specification could be outdated and not relevant to the market. It could invite the ambiguity, or it could make your job confusing. So we may need to improve the specification through several ways. First of all, using standardization. Standardization means simply that you decide certain standard, or you decide that certain characteristic as the standard for certain product. If you have purchased an item before and you have the sample and you know how it looks or how it designed, then you can use that previous specification as a new standard. Okay, so you use it as a standard, and every subsequent purchase must follow that standard. So standardization may have a lot of benefits. It may stabilize the product. It doesn't make a lot of variety. It reduce the variety and support training, make the product more accessible to the stakeholder, and reduce the cost for manufacturing. When we decide that every product must follow the same standard, then economy of scale is easier to achieve. Okay, so that is very great advantage of standardization. There are three types of standardization. You can standardize the process, you can standardize the product, or you can standardize the part. Anyway, then the greatest advantage of standardization is about first reducing variety, and second, help you to achieve the economy scale because everything is done in the same way. We also have other ways to improve the uh, we also have other way to improve the specification, that is value analysis and value engineering. Um, they are basically similar process to improve the product. So here, for both processes, then we need to understand about their function, and then we need to analyze the elements and identify whether we can improve the product through standardization or removing some parts or switching to another supplier, etc. So for value analysis, first, it applies to an existing product. We need to identify the design function of that product through the market analysis. And we know that the customer may want certain function, certain features. Next, we need to decide the target costing of that product or the target price of that product. And then we may try to break them down into different cost element, into different um, parts, and then we try to improve each part by incremental change, like changing the material, changing the design, adjusting the tolerance, or switching to another supplier. Okay, so when we do this and we sum it up to all together, then the cost for that product may reduce and improve our bottom line. On the other hand, when we have value engineering, then it means to apply to the new product only. So the process here has some small differences. First, we still need to identify the desired function. But here, since it is a new product, so we need to do the survey and understand what problem the customer is facing. And then we can generate the possible idea, possible prototype or product that customer may like. And then we may launch a new prototype and improve the value of that product by using the principles of value analysis. To the end, both of these processes are pretty complex and require a lot of collaboration with different stakeholders. So it is required that so in the exam they don't ask that difficult, and you only need to identify the difference between value analysis and value engineering. The key here is that value analysis is about improving the existing product, and value engineering is about improving the new product. So that is a major difference. And together, value analysis could be used in combination with standardization. We can break down the product and then standardize the part. Okay, so we have combination of value analysis and standardization. Okay, so you need to understand that as well. And there could be a question about both of these processes. All right, so that's all for today. And next time, maybe in 2026, we may have other revision in OR. So if you have other exam or other suggestion, please contact us on WhatsApp and email. We are happy to answer you. And thank you very much for your participation today. Wish you a Merry Christmas and Happy 2026 with a lot of success in C exam. Goodbye for now and see you later.